welcome to FinBot Insights. Today, we're dissecting Vanguard's 2026 outlook, and this report is a direct challenge to the very foundation of the current tech-led bull market.
You know, this forecast isn't just some minor update. It's a meticulously crafted argument, a direct shot at the market's ongoing love affair with tech stocks. So, throughout this explainer, we're going to break down exactly what their contrarian view is, and more importantly, what it could mean for asset allocation in the years ahead.
So, what's at the very heart of Vanguard's argument? Well, it all boils down to a really compelling paradox. The idea is that while artificial intelligence is absolutely set to revolutionize our economy, it might not be the straightforward golden ticket for investors that everyone seems to think it is.
And the paradox itself? It's actually elegantly simple. On one hand, AI gives a huge boost, a powerful tailwind to the real economy. But on the other hand, it could create a major headwind for the very tech giants that are dominating the market right now. And that is the central tension we're going to dig into.
Okay, let's get to the numbers. We need to look at the data that forms the very foundation of Vanguard's perspective, starting with their global economic forecasts.
So this is where it gets really interesting. Vanguard is actually surprisingly bullish on U.S. economic growth. They're projecting a sustained expansion that's way ahead of what most analysts are expecting. And this isn't just a guess. Their optimism is rooted in the massive wave of real physical investment we're seeing in AI infrastructure. They see this spending cycle as a total game changer for productivity.
Now, take a close look at this table, because the divergence it shows is key. For the United States, Vanguard is forecasting strong GDP growth, but also stubbornly high inflation. And that combination right there is absolutely critical. Why? Because it ties the Federal Reserve's hands. It makes it really, really difficult for them to deliver the big interest rate cuts the market seems to be pricing in.
So this brings us to the million-dollar question, right? If the U.S. economy is going to be so robust, why is Vanguard so cautious about the tech stocks that are supposed to be benefiting the most? Well, that's exactly what we're going to get into next.
Vanguard's skepticism really rests on two main arguments. First, they're saying that tech stock valuations are already priced for perfection. There's just no room left for error. But second, and this is probably the bigger point, they believe the market is completely underestimating the power of creative destruction, something that always comes along with major new technologies.
And if you look back at history, the lesson is crystal clear. The biggest long-term winners from a breakthrough technology are often the companies that use it, not just the ones that create it. It makes sense. New competitors always pop up, use that same tech to challenge the original players, and start eating away at their profit.
And here's the bottom line. Vanguard's pretty tame forecast for the U.S. stock market, well, it's a direct result of this huge concentration of risk in just a handful of mega-cap tech companies. The thinking is, if these giants stumble even a little, their massive size means they could drag the whole market down with them.
Okay, so with all this in mind, what's an investor's playbook here? Vanguard lays out a very clear and very different investment strategy. And believe me, it definitely goes against the grain. Their analysis points to three key areas of opportunity, and what's really telling is that all of them are outside of that crowded space of U.S. growth and tech stocks. Vanguard is making a really strong case for high-quality bonds. They argue that since interest rates are now structurally higher, the new normal isn't near zero anymore, bonds are offering genuinely attractive returns. They're not just about income, they also act as a critical safe haven if the stock market takes a nosedive or the economy hits a rough patch.
All right, let's pull all of this together. If we want to boil down Vanguard's entire outlook, it really comes down to a few critical takeaways.
So here are the main things to remember. Vanguard's message is unambiguous. The market is obsessed with U.S. tech valuations, and it's missing the bigger picture. A stronger-than-expected economy, stickier inflation, and the clear lessons of history all point toward a different set of investment opportunities in the years to come.
Now, before we wrap up, I have to make something perfectly clear. This analysis is for informational purposes only. It is not, and I repeat, not financial advice. You have to do your own research. Please, never, ever base your investment decisions on what you see on this channel or any other social media channel.
And finally, if you got some value out of this breakdown of Vanguard's outlook, the best way to support us is to hit that like button and subscribe to the channel. We'll have more deep dives like this coming your way.
And that leaves us with the one central question that's going to define investing for the next decade. Will AI's impact on the market just be a repeat of the boom and bust cycles we've seen with every other major technology? Or is this time actually different? Vanguard's analysis strongly suggests that history is our best guide here. But of course, the final chapter is yet to be written.